So accounting for merchandising businesses. The operating cycle is the process by which a company spends cash and generates revenues and receives cash either at the time the revenues are generated or later, depending on when they collect their accounts receivable. The operating cycle of a service and merchandising business differs in that a merchandising business must purchase merchandise for sale to customers. The differences between service and merchandising businesses are also reflected in their financial statements. The revenue activities of a merchandising business involves the buying and selling of merchandise. A merchandising business first purchases merchandise to sell to its customers. When the merchandise is sold, the revenue is reported as sales, and its cost is recognized as an expense called cost of merchandise sold. The cost of merchandise sold is subtracted from sales to arrive at gross profit, which is the profit before deducting your operating expenses. Merchandise on hand, anything that has not yet been sold, at the end of an accounting period is called your merchandise inventory. It's reported as a current asset on the balance sheet. Merchandise transactions are recorded in the accounts using the rules of debits and credits. However, the accounting system for merchandising businesses often modified to more efficiently record large numbers of transactions. A large number of individual accounts with a common characteristic can be grouped together in a separate ledger called a subsidiary ledger. The primary ledger, which contains all of the balance sheet and income statement accounts, is called the general ledger. Each subsidiary ledger is represented in the general ledger by summarizing account called a controlling account. So, should have an example of this in the book. I'll find that for you guys. So common subsidiary ledgers are accounts receivable, accounts payable, and an inventory subsidiary ledger. The accounts receivable subsidiary ledger, also known as a customer ledger, lists the individual customer accounts in alphabetical order. So kind of going back to yesterday, we mentioned like a tax person. If you do taxes and you have someone that gives you their taxes to have you perform the work for them, you may record them in your ledger under their name. So John Doe, and he would be recorded in your ledger. He could be recorded in your ledger by his name, which would be John Doe. And it helps cut, like the larger the company, depending on how the company wants to track everything, kind of also how we talked about tracking by jobs. A job could be a customer, so it just helps the company to be able to like keep track of that particular job or that customer so that they know, or that home that we talked about yesterday, if you had rental homes, to be able to track all the revenues and expenses that take place related to that customer or that job or that, that house, so that you can see, is this really bringing me in income or am I losing money on it? So the house, if you were spending more on it than you were bringing in, it needed a lot of repairs, and you could even run into something like that with a customer. Say say it is a tax customer and you charge this flat fee of X amount of dollars, but and you're paying somebody else hourly to do this work for you, and the customer keeps bringing in, little papers here and there that are just eating away at the time, and eventually you are paying your employee more money than the customer is paying you to do the work. So you just so the companies a lot of them track things based on job or customer, so they can see, like how they're doing in that particular area. Should we continue this going forward, or is this not really beneficial to us as a company? But they'll do that. That's the customer ledger. The accounts payable subsidiary ledger, you have creditors. It lists the individual creditor accounts in alphabetical order. So, if you owe money anywhere, if you have any creditors, they'll have them listed out there, and that's how they can track, how they're paying when they're paying their creditors. The controlling account in the general ledger is the accounts payable for the accounts payable subsidiary ledger. The inventory subsidiary ledger lists individual inventory by item or barcode. So if you're a company that does have inventory, let's say you make mouses, you may have a barcode on each mouse or each type of mouse, and so you would have them listed out in your system with that barcode, so that anytime that mouse was sold, they would link it to the barcode, and then that helps you to easily track, well, which one is selling the most, which one should we produce more of, which one's selling the least. Maybe we can get rid of that altogether and put more efforts into creating the ones that do sell more, so that maybe that'll increase our profits. Most merchandising companies use computerized accounting systems that record similar transactions in separate journals called special journals. These journals generate purchase, sales, and inventory reports. Purchase transactions. So this is one of 3 slides. There are 2 systems for accounting for merchandise transactions: the Perpetual system and the Periodic system. Do y'all remember hearing those before? Probably, maybe. So in a Perpetual inventory system, each purchase and sale of merchandise is recorded in the inventory account and related subsidiary ledger. In the periodic inventory system, the inventory does not show the amount of merchandise available for sale and the amount sold. Instead, in periodic inventory system, a listing of inventory on hand, called a physical inventory, is prepared at the end of the accounting period. Under the Perpetual inventory system, cash purchases of merchandise are recorded as a debit to merchandise inventory and a credit to cash. Purchases of merchandise on an account are recorded as a debit to merchandise inventory and a credit to accounts payable. And the terms of purchases on account are normally indicated on the invoice or bill that the seller sends to the buyer. The terms for when payments for merchandise are to be made are called credit terms. Do y'all remember hearing about those? Like 210 net. If payment is required on delivery, the terms are cash or net cash. Otherwise, the buyer is allowed an amount of time known as the credit period in which to pay. Discounts taken by the buyer for early payment of an invoice are called purchase discounts. So sometimes companies will offer, if you pay within 5 days of receiving of the date of this invoice, or 10 days of the date of this invoice, then you'll get a 5% discount or a 2% discount. And they do that because they are hoping to get a quick turnaround on the money that is owed to them. And companies that owe the money, obviously, they do that. They'll pay the invoices early so that they can get that discount. And I've kind of seen it go both ways in real life. So there are some companies that are really big on trying to take advantage of that discount. So as soon as they get the invoice, they want their checks cut and payment sent immediately so that they can get that 2% or 5% discount, whatever it is. And then there are other companies that prefer to keep the money in their bank account and prefer to just, take care of it before it's due. So it kind of depends on who you're working for. So I know none of y'all really plan to be accountants, but if you're working in an office setting, if you're doing anything related to payments and stuff like that, it's definitely a good idea to find out from your boss or your manager or the owner or whoever it is how they want those types of things handled, because some owners, they want the 2% discount, pay it immediately, and then other ones are, they're like, no, we'll hold it, wait and pay them. If it's due on the 15th, send them a check on the 10th. So just kind of like find out from them how they want that done. Since buyers normally take all purchase discounts, merchandise inventory is debited for the net purchase price under the Perpetual inventory system. That is, the buyer debits your merchandise inventory for the amount of the invoice minus the discount. So the discount's taken out of, it's not included in the merchandise inventory. A buyer may request an allowance for merchandise that is returned, like a purchase return, or a price allowance, purchases allowance, for damaged or defective merchandise. From a buyer's perspective, such returns and allowances are called purchases, returns, and allowances. In both cases, the buyer normally sends the seller a debit memorandum, often called a debit memo, which I've seen that term used more often, the debit memo, to notify the seller of reasons for the return, like if there's any like defects, and to request a price reduction. So in some cases, they'd give you a price reduction or a discount on the product, and then in other cases, you may be getting a full refund, sending the product back. And you have to account for all that using journal entries. So the buyer may use the debit memo as the basis for recording the return or allowance, or wait for approval from the seller, the creditor. In either case, the buyer debits accounts payable and credits merchandise inventory. Before paying an invoice, the buyer may return merchandise or be granted a price allowance for an invoice with a purchase discount. In this case, the amount of the return is recorded at its invoice amount less the discount amount. So cash sales, this is slide 1 of 2. Revenue for merchandise sales is usually recorded as a sale. Cash sales are recorded as a debit to cash and a credit to sales. At the same time, under the Perpetual inventory system, the cost of merchandise sold is debited and the merchandise inventory account is credited, which that's going to decrease the inventory account. In this way, the merchandise inventory account indicates the amount of merchandise on hand, which is the merchandise that we have not yet sold. Sales may be made to customers using credit cards, such as a MasterCard or a Visa, and those are considered cash sales. Any processing fees that are charged by the clearinghouse or the issuing bank, those are periodically recorded as an expense. So credit card fees, processing fees, those are recorded as an expense. And this expense is normally recorded as a debit to the credit card expense account and a credit to your cash account. Credit sales are recorded as a debit to accounts receivable and a credit to your sales account. At the same time, under the perpetual inventory system, the cost of merchandise sold is debited and merchandise inventory is credited or decreased. A seller may grant customers a variety of discounts called customer discounts as incentives to encourage customers to act in a way that benefits the seller. A sales discount encourages customers to pay their invoice early. So an example of a sales discount or credit terms would be this 210 N30. Anyone know what the N stands for?
I don't remember. I think I've seen it on the balance sheet before, like on the on T accounts or something like that. I think I've seen that before on there, but I'm not sure.
Anyone want to take a guess at what any of the numbers mean? 210 N30. Can you see my mouse? So the 2 is the percent. So it's saying that you get a 2% sales discount if the invoice is paid within 10 days, and then N30 means net 30. So N30, they're saying that no matter what, the invoice has to be paid within 30 days. Your due date is in 30 days, but if you pay us within 10 days, we'll give you a 2% sales discount. And this is probably the most common one that I've seen, 210 net 30. But like I said earlier, you can see all sorts of different ones. Some companies require you to pay them within 15 days. So you would see a 210 net 15. Some companies offer a higher discount rate or even a lower one. You may see 110 net 30 or 510 net 30. So, but just know that the 2 is the percent of the discount. The second number is going to be how many days they want it paid, which I think for this class, 210 N30 is the only scenario that you'll see. I don't think you'll see any others, but just to kind of know, like in the real out there working, you could see other numbers besides 210 net 30. But just know what those are. Know that, 2 is the discount, so 210 net 30. So, if you're doing a calculation that is asking you how to calculate, how much the sales discount is or something like that, just know that when it says 210, 2 is your discount. And so you would be taking 2% from whatever that sell amount is if you have a question like that. Merchandise sold may be returned to the seller, also known as a return. In other cases, the seller may reduce the initial selling price or allowances. This might occur if the merchandise is defective, damaged during shipment, or does not meet the buyer's expectations. From a seller's perspective, these are termed customer returns and allowances, sometimes called sales returns and allowances. In some cases, a customer that is due a refund has an outstanding account receivable balance. In this case, the seller may credit the customer's accounts receivable rather than pay cash. And when this is done, the seller normally sends the buyer a credit memorandum or credit memo that indicates its intent to credit the customer's accounts receivable. So they're letting them know that they are going to get a credit on their account. The ownership of the merchandise may pass to the buyer when the seller delivers the merchandise to the freight carrier. So when you have freight, you have items being delivered, there are certain shipping terms that you could see. So one of those is this FOB, free onboard shipping. And the free onboard shipping, the term means that the buyer pays for the freight cost from the shipping point to the final destination. So I'm purchasing something that's being shipped to Georgia Military College. I'm paying for that item to be shipped from where it is to here. The owners of the merchandise may pass to the buyer. The ownership of the merchandise may pass to the buyer when the buyer receives the merchandise. So free onboard destination, this is where the seller pays the freight cost from shipping point to final destination. So the seller would pay for the cost and they would ship it from their location to mine. And in this case, the seller might prepay the freight, even though the terms are free on board shipping point, the seller pays that freight charge. Almost all states levy a tax on the sales of merchandise. The liability for the sales tax is incurred when the sale is made. So at the time of a cash sale, the seller collects the sales tax. When a sale is made on account, the seller charges the tax to the buyer by debiting accounts receivable. The seller credits the sales account for the amount of the sale, and they credit the tax to the sales tax payable account. Wholesalers are companies that sell merchandise to other businesses rather than to the public. Many publish sales catalogs. So rather than updating their catalogs, wholesalers might publish their price updates. A lot of times they'll send those updates out to their customers so that they have that information, and normally they'll do it in advance, like a month or two, maybe even 3 months in advance, letting their customers know that the prices for these items are going to go up or down. You might see that a lot with like companies that are, construction supply companies, and then the smaller businesses that purchase those, like wood, for instance. The price of wood fluctuates a lot. It goes up and down a lot. So you may see a company that will send that information out to let their customers know, this is going to go up or down, and that change is going to take effect on February 1st. In addition, wholesalers often offer special discounts to government agencies or businesses that order large quantities. Such discounts are called trade discounts, which are not recorded in the accounting records. I have not dealt with any trade discounts, but I haven't been in that profession. I'm sure they're out there, but the multiple step income statement, you can also call it the multi-step income statement, contains several sections, subsections, and subtitles that include sales, cost of merchandise sold, gross profit, income from operations, and other income and expense. So when looking at income from operations, or also known as operating income, it's determined by subtracting operating expenses from gross profit. Operating expenses are normally classified as either a selling expense or an administrative expense. Selling expenses are incurred directly in the selling of merchandise. Administrative expenses, which are sometimes called general expenses, are incurred in the administration or general operations of the business. So, can you think of any administrative expenses? General operations of the business.
So like electric bills and stuff like that?
Mm,
It
So-
says incurred in the administrative general operations of the business, so it has something to do with operations, right? Like the business.
Administrative expenses, also called general expenses, incurred in the administration or general operations of the business.
Salaries.
You could think of like an admin salary. Yep. But you could also, I mean, some companies would even put like their software under that. Like if they use QuickBooks for their bookkeeping, they could put QuickBooks under administrative expenses, or they might have it under their like their IT expenses, or you know, I'm gonna stop there though, because I don't want to confuse you. Because in the real world, I think I've mentioned that before too. In the real world, some categories can kind of be listed here or there based on their interpretation of what it, as long as the transactions within the account are supposed to be there.
Yeah.
I don't want to go too, because I don't want to confuse you, but so we'll just stick with that. So like an administrative could be like an admin assistant would be a definite good example of that. So other income and expense items are not related to the primary operations of the business. Other income could be revenue from sources that are not primary operating activities. Other expenses could be, those are expenses that cannot directly be traced to the normal operations of the business. I don't see a lot of items that are listed in other. I mean, you will have some, but when you think about it, you kind of think about a miscellaneous account too. Like, what is miscellaneous? It's just where people put everything. But more than likely, there's somewhere that it can go that's better than miscellaneous. And I've found that a lot with other income and other expense accounts. There are some items that do go there, but a lot of times though you can find a better place for it where it fits. So, but just note that you know, it's from sources that are not primary operating activity is your other income account. And then, I mean, you could have like, so your primary operating revenue would be if you sell pens, then any money that you receive from selling pens, that would be listed as income. It would be primary, right? But then let's say that you just happened to, I don't know, sell a notebook, and that's not what you normally do. Well, that's not your primary source, right? But you still made money off of the notebook, so that would be, you know, justifiable to put in your other income area. And the same thing goes for expenses. An alternative form of income statement is the single-step income statement. The single-step form deducts the total of all expenses in one step from the total of all revenues. So this is an example of a retained earnings statement. And let's see if I can. So you'll see here, so you've got your retained earnings from January 1, and then we're pulling in our net income from the income statement. So if the income statement's wrong, our retained earnings is wrong. Kind of going back to yesterday, how all the statements kind of flow into each other or feed into each other. But then we also take out any dividends, and that gives us our increase or decrease in retained earnings, and then sum all that up to get whatever our retained earnings balance is at the end of the year. So the balance sheet may be presented with assets on the left side and liabilities and stockholders' equity on the right-hand side. The balance sheet is very similar to our accounting equation, right? Assets equal liabilities plus equity. The balance sheet is set up the exact same way, where all of our assets are on the left and our liabilities and equity are on the right. And this form of the balance sheet is called the account form. The balance sheet can also be presented as a downward sequence in 3 sections. This one is, this is where we list out our assets and then our liabilities and then our equity, just straight up and down, top to bottom. We don't separate it from left-hand side to right-hand side. And this form of balance sheet is called the report form. The adjusting entry for inventory shrinkage. Under the perpetual inventory system, the balance of the merchandise inventory account is the amount of merchandise available for sale at that point in time. Accounting records that continuously disclose the amount of inventory. However, retailers normally experience some loss of inventory due to shoplifting, employee theft, or errors. So therefore, the physical inventory on hand at the end of the accounting period is usually less than the balance of your merchandise inventory. Because merchandise inventory is perpetual. So it's supposed to be more of a real-time, point-in-time type of tracking system. And, you know, mentioning here shoplifting or theft or errors, you know, if we're not accounting for anything that may have been taken out of the store. So at the end of the period, when we're physically counting, we're doing that physical inventory count to see how many items we have. They're saying that this number is usually less than what we had accounted because some items may have come up missing. The difference in the inventory is called inventory shrinkage or inventory shortage. And it's debited to the cost of merchandise sold and it's credited to our merchandise inventory. So there are 4 closing entries for a merchandising business. We debit each temporary account with a credit balance, such as sales, for its balance, and then we'll credit the income summary. We'll credit each temporary account with a debit balance, such as the various expenses, and debit the income summary. Since the cost of merchandise sold is a temporary account that has a debit balance, we're going to credit that account to zero that out because it's a temporary account. The debit income summary for the amount of its balance net income and credit the retained earnings account. Those accounts that are debited and credited are reversed if there's a net loss. So if it's a net loss, we would reverse that. It would be credited to the income summary and debited to retained earnings. And then, finally, you would debit the retained earnings account for the balance of the dividends account and credit the dividends account. So maybe when you're working through some problems, you may want to refer back to this slide to see the various debit and credit scenarios.
It sounds super confusing.
It sounds complex.
Yeah, and a lot of stuff. So I'm just thinking in my head, like, what the question is going to look like a little bit versus what scenario, you know.
Yeah.
So sounds like a lot though.
We got some practice problems. Okay. So the ratio of sales to assets measures how effectively a business is using its assets to generate sales. A high ratio indicates an effective use of sales. And then to find the ratio of sales to assets, you're going to, let me just pull this up for you. You're going to debit the sales to assets. Let me see if I can get this on a bigger screen for you guys. Because for some reason, it's still doing that. I'm going to have to relearn PowerPoint. No. So to find the ratio of sales to assets, you're going to take your sales divided by your average total assets, and that's going to give you the ratio of sales to assets. And this is going to tell you how effectively you're using the business is using their assets to generate sales. So using the periodic inventory system, purchases of inventory are not recorded in the merchandise inventory account. Instead, purchases, discounts, and purchase returns and allowances accounts are used. In addition, the sales of merchandise are not recorded in the inventory account. Thus, there is no detailed record of the amount of inventory on hand at any given time. At the end of the period, a physical count of merchandise inventory on hand is taken, and the physical count is used to determine the cost of merchandise sold. Under the periodic inventory system, freight paid when purchasing merchandise free on board shipping point is debited to the freight in, the transportation in, or a similar account. So there's a freight in account, there's a freight out account. Transportation in, transportation out. So they're saying that under the periodic inventory system, freight paid free on board shipping point is debited to the freight in position account, or the freight in transportation account. I can't talk. I'm like, I just messed that one up too. Transportation in account. This is a long one. So the 4 closing entries under the periodic inventory system. So we already looked at the perpetual. So the 4 closing entries under the periodic system are: debit each temporary account with a credit balance, such as sales, for its balance, and credit the income summary. Since purchase discounts and purchase returns and allowances are temporary accounts with credit balances, they are debited for their balances. In addition, merchandise inventory is debited for its end of period balance based on the end of period physical inventory. You'll credit each temporary account with a debit balance, such as the various expenses, and debit the income summary. Since freight in is a temporary account with a debit balance, it is credited for its balance. In addition, merchandise inventory is credited for its balance as of the beginning of the period. Debit the income summary for the amount of its balance, net income, and credit the retained earnings account. The accounts debited and credited are reversed if there is a net loss. The same as the other one. If there's a net loss, you'd credit the income summary and you'd reverse those. Credit the income summary and debit the retained earnings account. And then finally, debit the retained earnings account for the balance of the dividends account and credit the dividends account.
Oh, here we go.
Now we're going to work some problems.
Calculate the gross profit of Jefferson Company. Sales expense. Cost of merchandise sold.
Anybody know what the formula is that we're going to use for this one?
You would add like the equation that we have up there, or just,
Not that equation.
or
Not
just-
assets equals liabilities plus equity. But so we're calculating the gross profit for Jefferson Company. So do we know how to calculate the gross profit?
It'd be the expenses, like total expenses.
So to calculate the gross profit, we're going to take the sales of 76,764. We're going to subtract out the cost of merchandise sold, and that's going to give us our gross profit. So we're actually not going to do anything with the expenses, with the selling expenses. So gross profit equals the sales minus the cost of merchandise sold. And that's going to give us the 226,000.
Chapter 5.
So we're going to go to the next one. Very good. All right, so this is one of those 210 net problems. I apologize, this is 215 net 45. But we'll work on that one. Did any of y'all do that to solve this? Okay. To find the amount of sales, you're going to take the amount of the invoice minus whatever the sales discount is. To find the sales discount, you're going to take a percent and multiply that by the amount of the sale. So what answer did y'all get? Okay, good. So we'll go to the next slide. So we took the amount of 25,500, and then we needed to find that sales discount. So we know 2 is the discount. So 2% is our discount times that total amount of 25,500 is going to give us what that discount rate was, or that discount amount was. So then we're going to, which was 510. So we're going to take that full amount, the sales amount of $2,500 and $500 minus the 510, which is going to give us 24,000. Sorry, $24,990. Did anybody not get that one or have questions about it? Okay. Another one. So I'll give y'all a few minutes for this one. Y'all already have the answer? All right, what do you have? Okay, good. That's correct. So 500 is the answer. To find the sales discount allowable, 2% discount, we know that because it says 210 up here in the terms, times that total amount, which is 25,000, gives us 500. That's it. That's it for this chapter. Do y'all have any questions?